Okay, you can start now.
Hi everyone, this is Kathy Lien with BK Forex. First, I'd like to make sure I can do a sound check. If you can all hear me, type in yes into the chat box, or at least a handful of you type in yes. Can you all hear me? Yes, no, maybe. I'm not seeing any. Okay, Adina. Seems like you're the only one that's engaging right now, which is fine. So it looks like I'm not too sure how many people in the room right now, but it looks like we're ready to get started. Hopefully this event is already being recorded. I'm very excited to be here. We're hoping that this will be the start of a monthly engagement with all of you where, we take some time pre-NFPs to talk about what we can anticipate for non-farm payrolls. So I'm going to spend the next 30 minutes just talking. Feel free to fire away with questions. Obviously, today is a very big day, so we have a lot more to talk about than NFPs, but feel free to, ask any questions that you may have. Now, to start off with, I think it's important to discuss kind of what is the general tone of the market. So, the biggest story today is obviously the euro-dollar short squeeze and how, the ECB disappointed. And many people are wondering, does this mean that we'll have a greater short squeeze in the euro-dollar? And of course, a large part of that hinges upon the NFP report and what the Federal Reserve will do on December 16th. But if you take a step back, Eurozone rates are at negative 0.3% right now, and U.S. rates are already, the 0.25%. They're expected to increase even further. So the spread between Eurozone and U.S. rates will be moving in the dollar's favor. And investors are being punished for holding euros. And I think that when the dust settles, I think the euro-funded carry trade it may very much, come back into play and be something that, the market very much pays attention to. So I've got a great question. Let me try to share my screen here. Just give me 1 second to do that. I just need to fiddle around with some of these things because I have way too many screens open in my box. Just give me 1 second. All right, so I'm sharing my screen. We're going to pop on my charts first. So I believe that you should be looking at my charts right now. So the question is, how do we trade euros from here? Well, this 109, 110 region is a very important resistance level in the euro dollar. I think, pretty much around current levels between now and 110 is probably pretty good levels to short the euro dollar. And, there's two ways that we kind of looked at this. The first way is that the flush that we saw in the markets actually gave us an opportunity to buy dollar yen into NFPs and FOMC. Now, in terms of, selling euros, euro dollar looks really good, but I think the more attractive trade, in my opinion, is actually selling euro Aussie, because that's where we're probably going to get, that is where we have one of the greatest divergences between interest rates. And so while the euro dollar itself is quite attractive, I think euro Aussie is even more attractive. And we've seen some decent improvements in Australian data, and I think anywhere below 150 is a pretty good opportunity to sell euro dollar for maybe a move back to euro Aussie, I meant, for a move back to 146, because it is these euro funded carry trades that I think are going to kind of see renewed demand. So that's looking pretty good. Euro pound sell also looks pretty good. And with that, you kind of take out the risk of the US dollar, and maybe the Federal Reserve maybe an NFP is disappointing or the Federal Reserve disappointing. So I think that that gives us a good opportunity to talk about NFPs, and we can come back to the euro later on. But today's focus is NFPs. So with the non-farm payrolls report, I think the first thing we want to look at is what is the market anticipating. So what is it that we're potentially looking at? So let me see if I can share with you my other screen. Okay, so right now I think you should be looking at my Bloomberg terminal, and what you see here is the market's current expectations for the NFP report. I'm actually going to, on my other computer, pull up the FX Street page so that I make sure that you guys can see what I see. But bottom line is market's looking for job growth. I mean, first of all, the market is realistic. They realize that the number that we had, last month was very, very strong. So given that last month's report was so strong, I think the market realistically realizes that chances are we're going to have a slightly less job growth. So economists are basically looking for only 200,000 jobs to be created, and they're looking for the unemployment rate to hold steady. One very, very important line item is average hourly earnings. They're looking for average hourly earnings growth to slow, and they're looking for the participation. Actually, there's no forecast for the participation rate, but these are all different things that we need to pay attention to for tomorrow's report, because non-farm payrolls is always important, but this month's non-farm payrolls report is even more important because it is the data point that the Fed is hinging this month's liftoff on. We heard from Yellen this morning, and she said to us that, or she admitted to us that the November labor market report is going to be very, very important, because even we had 1 month of good job growth, but beyond that, we actually have more disappointments in U.S. data than improvements since the last, in the past week at least. I mean, just take a look at what I was looking at earlier, where you all probably know by now that the ISM non-manufacturing index kind of nosedived in November, and the employment component of that report also fell quite steeply, and the ISM manufacturing index ended up contracting. So all of that taken together is kind of bad news for the non-farm payrolls report, especially if we take a look at the ISM non-manufacturing report. Let me just kind of pull that up, because I want to show you why why I follow this so closely. So if I pull up the employment components, let me see if we can build a chart. NAPM and EMP. Okay, this is what we want. So we want this. We want it as a histogram, and then we're going to add. Can someone tell me, make sure you're seeing my Bloomberg move right now with the histogram that I'm creating. So I'm adding non-farm payrolls. Okay, I think the line chart is fine. Finish. NFP. Okay, so, and let's just make this 2 years. So, can you confirm to me that you're seeing my NFP graph histogram right now? Great. All right, so the yellow line is actually non-farm payrolls, and the white line is the employment component of the ISM non-manufacturing non-manufacturing index. So last month you saw that the histogram increased, and so non-farm payrolls increased as well. Some other readings, like here between July and August, we saw a nosedive in histogram. That was also a nosedive in NFPs. There are divergences, like between June and July, we saw a big jump in histogram, but we did not see a jump in non-farm payrolls. But for the most part, especially for the most part, we do have these numbers are relative. These directions are relatively consistent. So this nosedive that we have in NFPs, nosedive with the employment component of ISM does signal that we could potentially have weaker NFPs. Now, the good thing is that the market or economists are already looking for weaker NFPs. They expect only 200,000 job growth and not 271,000. So we could still get a number that drives the US dollar higher. And that is something that could, revive this euro dollar sell trade and remind everyone that the divergence is there for the euro. So the other thing that's really important to think about before I get more into these leading indicators expectations is how is the market positioned? Now, first and foremost, if you take a look at my chart screen, let me revert back to the chart. So if I revert back to the chart, you'll see that for the most part, typically when we trade non-farm payrolls, the best pair that reflects the market's expectations for payrolls is going to be dollar yen, because it's the purest reaction that you can have with regards to US data. And you can see the dollar is still trading pretty firm. And, while we're also seeing the dollar trade firm remain strong against the Aussie, Kiwi, and the Canadian dollar. So aside from this, short squeeze that we're seeing in the euro dollar and this liquidation that we're seeing in dollar Swiss, for the most part, the market is still looking for a good non-farm payrolls report. Now, taking a look at interest rate projections. Let me go back to my Bloomberg screen. And let me flip you back to my Bloomberg screen. So I flip you back to my Bloomberg screen. The first thing I want to show you is that, first and foremost, U.S. Treasury yields are up sharply this morning. They're up 10 basis points, which means, yes, the market is pricing in or looking for a good number. And if we flip over to Federal Reserve interest rate probabilities, the market is pricing in 76% chance of a 25 basis point rate hike this month. So yes, the market from a stock perspective, because stocks are down today, from a US dollar perspective in dollar yen, as well as the commodity currencies, from a bonds yield perspective, as well as from a Fed funds futures interest rate probability perspective, are all positioning for a good number. So that begs the question that one of you asked is, could NFPs disappoint like the ECB? Because the ECB eased, they took what would normally be perceived as pretty aggressive measures to stimulate the economy, and some good measures that basically stimulate the economy, and yet the euro soared because they didn't quite do enough. And so that's something that's kind of important to pay attention to, because expectations are very important as well. So we set the stage and we talked about how the market has, all of these different markets that we look at. And even if I pop on commodities, commodities are kind of mixed. Oil is up a little bit, gold is flat. So there's really no direction in commodities, but they're more up than down. But for the most part, most of the other markets are looking for a good number that will reinforce the that will basically reinforce the Federal Reserve's plans for raising interest rates. So the question of whether the Federal Reserve is going to disappoint or not leads us to look at the leading indicators for non-farm payrolls. So let me, I actually published on Twitter, on my Twitter feed. For those of you that don't follow me on Twitter, you should, because I post a lot of interesting stuff on there. But let me share with you this little graphic that I posted on Twitter. Okay. So I posted this little graphic. It says, could non-farm payrolls disappoint? Take a look yourself. And I laid out the arguments in favor of stronger versus weaker payrolls. At first glance, you can see, though there's a lot more arguments in favor of stronger payrolls than weaker payrolls. For example, the ADP report increased to 217,000 from 196,000. Challenger layoffs and Christmas also reported a larger decline in layoffs. One second. Continuing claims dropped marginally. The employment component of the ISM Manufacturing Index increased, and the University of Michigan Consumer Sentiment Index increased. But the arguments for weaker payrolls are the following. There was a sharp drop in the employment component of ISM non-manufacturing that we just took a look at. The 4-week moving average of jobless claims rose to 269,000 from 262,000. And the consumer confidence index dropped to its lowest level since September. So taking a step back, first and foremost, the two confidence measures offset themselves. I mean, one is up, one is down, so pretty much they're flat. Although I do have to say that the disappointment in the consumer confidence and the conference board's consumer confidence measure is a lot more significant than the improvement that we saw in the University of Michigan survey. Challenger Great and Christmas, not really that big of a deal. No one really pays too much attention to that. The 4-week moving average of claims, if we take a step back, even though it increased marginally. I mean, 269 from 262, that's still very, very low levels, indicative, consistent with a relatively healthy U.S. Labor markets. So, that's also not something that we have to be all that worried about. Same story with continuing claims, there wasn't much change. So, and the employment component of ISM manufacturing, the non-farm payrolls report actually does not measure the manufacturing sector. It only measures the service sector. So we keep this in here because it is reflective of the U.S. economy as a whole. But ultimately, I think it's more the service sector is much more important. So what's the ones that matter? The ones that matter are the ADP employment index. Now, the absolute amount typically with ADP is not very accurate because you can see last month they reported 196 and the actual jobs number was 271. But what is important with ADP is the direction, because the direction plays a very big role in the direction plays a pretty big role, I think, in what the market thinks. The direction is actually quite accurate in forecasting where non-farm payrolls in general could increase to. So, just something important to pay attention to. And also, ADP can be subject to revisions. So bottom line is ADP increased and the employment component of ISM non-manufacturing declined. So those are the two most important pieces of the puzzle that we pay attention to. And unfortunately, it does suggest that we could have that labor market gains will be less in November versus October. But remember, we also established that the market's already looking for a softer number. So how do we trade non-farm payrolls? Well, we already talked about how taking a look at this list, there is scope for a downside surprise. And I think with the NFP report, there's going to be a first and second phase in the US dollar reaction. Now, before I get too much into this, it's also, there's another thing that's really important to realize. I'm sure many of you do already. Let me pop up my Bloomberg screen again. Just give me a second. Let me just get to my Bloomberg screen again. Okay. When it comes to NFPs, it is not just the headline number that's important. We all know that you've got to look at the unemployment rate. You've got to look at average hourly earnings. You've got to look at the labor force participation. So there's always the knee-jerk reaction to the initial headline release, and then the market, and then relatively quickly thereafter, the market digests the rest of the report, and there's a reaction to the rest of the reports. But there's one other piece of the puzzle, which is revisions. And I do want to show you something here, which is that if I pull up this historical NFP number and I add a column showing the actual, what I want you to notice is, first of all, in October, there's no revisions yet. But in September, the September non-farm payrolls were revised down from 142 to 137. In August, it was revised down from 173 to 153. In July, it was revised up. In June, it was revised up. In May, it was revised down. In April, it was revised down. In March, it was revised down. In February, it was revised down. In January, it was revised down. So, in the last 9 months, 7 out of these 9 non-farm payroll numbers were revised down. So, last month was the strongest non-farm payrolls release we had seen this year. And chances are, if history is a guide, it will most likely also be revised down, because non-farm payrolls, as you saw from this general table, is almost always revised one way or the other, because predicting the actual number is very, very difficult and not something that economists have a completely firm grasp on. And because they don't really have a completely firm grasp of it, there is typically revisions and and quite a bit of revisions that can happen. So if we get a downward revision, of course, the magnitude is important. If it's like a 20,000 downward revision, that's not really that significant. If it's a 50, 60, 70,000 downward revision, then it is very significant. So that is also another piece of the puzzle that I think it is very important for traders to be aware of, to be cognizant of going into tomorrow's non-farm payrolls report. So how do we trade non-farm payrolls? I talked about how there's a two-phase reaction. The first reaction is going to be off of the headline release. And there's a couple different scenarios, obviously. Let's go back to our forecast. First, the baseline scenario that we're going to have is that the unemployment rate is going to remain unchanged at 5%, which I think is a very, very good chance of happening. So let's take that off the table. So the focus is then non-farm payrolls and average hourly earnings. So as long as non-farm payrolls is greater than 170,000, in my opinion, and average hourly earnings rise by 0.2% or more, we're going to get a US dollar rally, and dollar yen will challenge today's high of 123.56, and euro dollar will probably come back down to 108. The stronger the NFP number, the greater the increase in average hourly earnings, the better it is for the US dollar. Of course, we get 200,000 and 0.2%. I think it's a green light for tightening. If we get 250, markets can get really excited with that, especially if average hourly earnings are in line or better. Now, the other scenario, of course, if for whatever reason we get 275 or 300, that's just going to be a blowout dollar rally. But based upon the leading indicators for non-farm payrolls, that is extremely, extremely unlikely. The other scenario, which is what happens if we get a weaker payrolls, and what's considered a weaker payrolls? Well, anything I think less than 160,000 is going to be a disappointment. The dollar is going to sell off initially. You're probably going to see dollar yen come into 122.40 or something like that, which is the low for the past few weeks. And then it'll be based upon average hourly earnings. If it's zero true, that's lower than the previous month. So that combined with 160 and less payrolls is probably going to take some of the steam out of the dollar yen rally initially. But as long as we're above 150,000, and as long as average hourly earnings growth does not slow further than 0.2%, liftoff next month is still on the table. So the decline in the dollar, in my opinion, that stage will probably be limited. The primary scenario where the US dollar could really collapse and the dollar longs could really be shaken out is if we have a situation where non-farm payrolls comes in 125,000 or less, and average hourly earnings is actually flat or negative. And in that case, then dollar bulls will be in trouble. And I think in that case, you're probably going to see a far more dramatic move in the dollar. So how do we trade non-farm payrolls based upon these scenarios? Let me go back to my charts. Give me 1 second to share my charts. Okay, so I'm going to share my charts. So the best way, in my opinion, to trade non-farm payrolls is to wait. We trade non-farm payrolls live with our members every single month, and it takes a lot of patience and a lot of experience to understand that waiting is the key to trading non-farm payrolls well. So we wait at least 15 minutes for the market to digest the non-farm payrolls report, and then we get to quote unquote trade the real reaction of the day. So we're going to be live tweeting non-farm payrolls. So I encourage you to follow me at Kathy Lien FX on Twitter to follow that. But in terms of positioning, non-farm payrolls is one of those things that will cause a breakout in dollar yen. So if dollar yen is trading, pretty much where it is right now, I think that you want to straddle wider. So you could probably place an order to buy above 123.70, for example, looking for a break of 124, or you can place an order to sell below 122 in case you get a big deviation in one way or the other. With the euro dollar, 110 is the main focus, so you can place order buy above 110 or order sell below 107.50. Now, that's for those of you that like the bigger moves, the big trades, the thematic developments, that because with non-farm payrolls, you're not just going to get a 5-minute move. Oftentimes, especially since this is such an important non-farm payrolls report, you're probably going to get a move that lasts for a couple of days in the week, sort of basically the week ahead. So whatever move, will have legs, in my opinion. But the flip side of it is that if you're a day trader, then there's different tactics that you want to take. With the day trader, what you may realize is that oftentimes the knee-jerk reaction in the euro dollar yen is reversed or faded or does not last. And so we believe, in our opinion, that with day trading NFPs, the best type of trades are the ones where you fade the moves, not follow the moves. Whereas with swing, and you fade the moves, not for big moves, you fade it for 10 to 25 pips. Whereas with the thematic trades, you want to straddle your orders and you want to ride the moves, afterwards. Once again, follow us on Twitter. We'll be talking about it, and you'll be more than welcome to follow what we're doing. All right, so now I'd like to open up any floor to any questions that you may have about anything related to non-farm payrolls, or the ECB. So I hear from one person says, well, Goldman's kind of has the same views. I feel like maybe it's a little bit of a trap. And maybe it could be. I mean, just like ECB today was a little bit of a trap. So, but I think that overall, though, there's more, this is a big event and it has implications for US monetary policy. So I think there could be quite dramatic impact on currencies. Any questions? What support do you see Eurodollar falling to if NFP delivers strong data, and to what resistance if it disappoints? Well, first and foremost, resistance is easy, resistance at 110, but I like to pop on my fib levels. Actually, that is not where I wanted. So, we don't have too many fib levels over here. So 110 is really the key level on the resistance side. And support, we actually have to turn to the hourly charts because, a lot of the moves did happen today. And if you look at the hourly charts, the initial support is at 107.88, which is one of the squeezes that we had higher. And then 106.50 is the other level to watch as support for the Eurodollar. Any other questions? Any other questions for me or charts that you might want to look at? Seems like it's a pretty quiet group. You must be just watching the price action in the markets right now and trying to see what is driving this fresh leg higher in the euro, which is now at a fresh high. And we don't have any comments, but, I think it's just a little bit of a continuation of the short squeeze. What is driving Aussie higher when gold? I mean, Aussie is benefiting from, Aussie, first of all, isn't really higher, but there will be Aussie demand based upon, just kind of euro-funded carry trades that, will probably end up being revived as a result of the greater negative yield offered by the ECB. So NFP could well break those 110 or 110.65 right up to the where thanks. I think it'll just get it right to there unless you get payrolls less than 125,000, which I think is very, very unlikely. What is your opinion in the case that the data is negative and that would be reflected in the Fed? And how do you think it's possible the Fed would raise? So it really depends how negative it is, because if it's only 150, 160, I don't think it's enough to take a rate hike off the table. But if it drops below 125, then I think, market's really going to second guess everything. And the Fed could as well. But, average hourly earnings, things like that are also pretty important. What about cable support and resistance? Well, I mean, cable itself, support is obviously at these lows here at 149 pretty much. And there's a bit of resistance at, if you take a look at this level, which we're kind of challenging right now, which is the swing low from September. and also some of the spike highs. I think that's really where the resistance level near term is at 152. 151.10. Obviously, that's not far from current levels, but the more significant support level, I think, is at 152. Any other questions? Any other questions that you may have? So I got a question here. I heard professionals do not trade NFPs. Your comments. We live trade NFPs every single month. And there's an invitation on Twitter to join our live trading session if you're interested and see how we make money live trading NFPs at Kathy Lien FX. If we see NFP dropping below 150,000, where do you expect the euro to go? 110 or higher? Yeah, I think it's definitely going to go to above 110. Who do you think is moving the market? It has to be big money. This is all short squeeze. Probably a lot of big money and small money that's happening right now. Any additional questions? I'm glad you're enjoying the breakdown. Happy pips. What level should Euro Aussie be shorted? Close to 150. 150 is a big round number. So I think usually around 60, 70 is probably a good level to start considering shorting Euro Aussie. But we're definitely seeing some crazy short squeezes happening right now. And I think it's not a coincidence that this is happening near the European close. Keep firing away with questions if you have them. Any additional questions? I bet all of you just kind of obsessing over what's happening in the markets right now rather than typing away questions. Anyway, I encourage you to follow me on Twitter at Kathy Lien FX if you don't already, because you'll only hear from me once a month here, but you can hear from me every day on Twitter. So, Adina, should we leave the room open and let people ask more questions, or we've got a pretty quiet crowd? Let me pull up my Twitter page so you can see exactly what my handle is. Give me 1 second. So my handle's right there at Kathy Lien FX. Also tomorrow at 12:15, I'll be on CNBC talking about everything that happened during halftime report. So tune in. So if you're interested in hearing my latest views. How the Fed may raise interest rates. Well, the Fed may raise interest rates if we get if the data is good enough for them to do so. What's driving Kiwi? Same story. It is euro-funded carry trades right now that's driving Kiwi higher, and also U.S. dollar weakness. Happy pips. I do write articles. You can get the link from my Twitter feed. Basically, you can see, like yesterday, I wrote. Where is this? Euro, the ECB's most alluring options. You can click on that. You can get my daily notes. Hopefully it'll load. I don't know what's wrong with my internet connection right now, but it should load and you should be able to read, my article there. Here it goes. And read, exactly what we were looking for and things like that. Any other questions? All right. If not, it was a delight spending the last 40 minutes with you. And I want to wish you all good luck on trading non-farm payrolls. Do you think we'll see parity on Eurodollar? No, I was never part of the parity party. I think it's just a big psychological level. But I think Eurodollar should be trading lower than where it is right now. How many pips do we usually make for NFPs? We can make anywhere from 10 to 100 pips off of NFPs. Follow us on Twitter and, find out. What do I think of Dale Pinkert? I'm not familiar with him. I'm sure that FX Street does a lot of due diligence when they select the people that they, have you spend time with. And so that is why, I trust their judgments. But personally, I'm not familiar with his work. Any other questions? Okay, if there are no additional questions, I think I'm supposed to do a summary of my views on this. So beginning questions, what is the floor for you in Eurodollar? I mean, we've risen so much, you have to expect the floor is where it was established around 105. Because especially since we're so close to FOMC date-wise. Should you try not to be shorting euros here? I'm short euros here. We got short right around 109. We had a pending order out. That's how we're trading it. Yes, Dale interviewed me, but I don't follow his work. So I can't really give it a judgment on that. But like I said, I'm sure FX Street does a really good due diligence on who they select to speak to you. So I'm sure he's got some credit out there. What did I want to say? Okay, so I'm supposed to give a quick recap of what we talked about today. So the big question is whether or not, maybe I should show my face while I do this. Unless Adita, you have any other instructions for me? Okay, so with regards to non-farm payrolls, the big question is whether the NFP report is going to disappoint like the ECB meeting. And we did see a very strong Eurodollar rally, which means it's broad-based US dollar weakness. And that's due to some mixed comments we've been hearing from Janet Yellen. So when we took a look at the leading indicators for non-farm payrolls during our webinar, we saw that while there are still far more arguments in favor of a strong payrolls report, the sharp decline in the employment component of the ISM non-manufacturing report is worrisome. So there is definitely scope for non-farm payrolls to be weaker in November versus October. But the main point to realize that the market is also expecting a softer number. And since they are expecting a softer number, there's a great deal of buffer room between 200,000 to 270,000. One way or the other, the NFP report on Friday will most certainly cause at least a 100 pip move one way or the other in the euro dollar, dollar yen. So breakout opportunities are there. On the short term basis, this real strategy to take with regards to trading non-farm payrolls is to wait. We always wait at least 15 and 20 minutes after the NFP release before taking a dollar trade, because once the dust settles, the real reaction of the day will probably occur. So that's my quick recap of what we talked about. In terms of, I know that, FX3 can go ahead and clip that out for the recap. We've got a couple other questions coming in while I was talking. So a short squeeze means that a lot of people were selling euros going into the ECB meeting. And when the ECB disappointed, they ended up closing their positions, or closing their short positions. And the process of closing their short positions ended up squeezing or driving the euro dollar higher. So that's why we call it short squeeze, because it's caused by a closure of short positions. What's a good target for euro dollar short from 109? I like to get into trade, revisit it over and over again. So I would short at 109, get out 108, short at 109, get out 108, so just kind of play that move. Am I also short Euro Aussie? I'm not short Euro Aussies right now because I'm already short Euro dollar and Euro pounds. And I don't want to overload on the Euro trade, because 2 is already too much for me. What's your thought about the equity and Forex market in the 2016 election year? Elections are another one of those really high profile events, and that really usually ends up not having a dramatic impact on the currency market. And I think that's very much going to remain the case this time around as well. All right, any other questions? All right, I got to get back to our trading team and our members who've been, hounding me about this move in the euro. So I thank all of you for joining me. And once again, please follow me on Twitter if you have questions that you want to ask, or you just want to know, what's going on. I'll be on CMEC halftime report talking about all of this week's big moves and the opportunities that come after that around noontime. So tune in if you are eager to hear my views. Thank you so much.